Okay. Yeah, so I want to use this opportunity to say a big welcome and happy to have each and every one of us in this section. Yeah, like Ijoma said, this is the tax season, and I know everybody will be looking forward to file their tax and all that. So it's very important for us to learn one or two things regarding to how we can file our tax. And in that case, if we have any questions to ask, of course, it's going to be a good time for us to throw that in. So we welcome you on behalf of Wintech community. I want to say a big thank you. Wintech is subsidiary of NIPCA, all right? And NIPCA is more like professionals in Canada, which comprises of male and also females. But we decided to like have a separate body where women can come together, learn as tech professionals, learn together, network, and also support one another through mentorship, through job opportunities, resume review, and so many other things, that we do. And again, it's not just for learning. We also banter in terms of our personal life as women. So I want to use this opportunity to welcome everyone. And if you are joining us in this call tonight and you are not part of Wintech community, you're going to see a link in the comment box. Click on that link and join our community, okay? Yeah, and having said that, thank you so much and welcome everyone. Thank you.
Thank you, Wendy. Welcome everyone. So now we're going to get to introduce our speaker. And before I introduce our guest speaker for today, like Wendy mentioned, you'll be able to ask questions. We have question and answer session after the speaker takes the floor. And then you can leave your questions in the comment section, and then we'll take it, we'll take the questions after our guest speaker is done. So the first, our guest speaker today is Folusho Akinyele. She's the founder of FAAB CPA Professional Corporation. She's an independent accounting, bookkeeping, and tax specializing that's a tax firm, and helping small and medium size businesses and enterprises to balance their books. So Folusho provides tax planning, bookkeeping, accounting, payroll services for corporate incomes as well as personal incomes and individuals. So currently she heads some large leadership positions in large international corporations, and she also works at the Canada Revenue Agency. And then today, she has graced our occasion, our event to bring more light to tax filing, the questions, the issues that we may have. And one of the things I want to say is that for this event, some of us are new to Canada. We need more information. How do we do this tax filing? How do I go about it? And then for some of us are existing, we've been in Canada for a while. Maybe we change jobs from contracts to permanent roles. So there are so many things, or maybe you're starting a business and you're like, what do I do next? How do I, file my tax for 2023 and all that. So it's good to have you here, and our guest speaker will be able to speak on all those things and take questions after the talk. So with a very warm Wintech welcome, let's welcome our guest speaker for today. Thank you.
Thank you so much, Ijoma, for the introduction. Good evening, everyone. Okay, so I am going to speed through my presentation because I know that, most of these sessions, people have questions that they want to ask. So that's usually the focus, but I would, try as much as possible to go through the slides so that new members, people who just will be filing taxes for the first time would be able to do that. And then, whatever else, some other information for homeowners, for businesses and all that, you'll be able to take one or two things away. One sec, let me just share my screen and then we'll start.
Are you able to share, Felicia?
Yeah, I think I just need to close. I think I have too many things open, so
Okay.
I just need to close a couple of things. Yeah.
Are you having any difficulties?
So can you see my screen?
Yes, we can see your screen now.
Okay. So I'm going to just go straight into the Canadian income, tax system, what it is about, and how it works. So the Canadian income tax system is based on self-assessment, which means that you're required to file your tax return by yourself. I know that for some of us where we come from, we probably never did tax filing at all. Our organizations took care of all the tax filings, but in Canada, the responsibility, to file your tax return rests with you. But luckily, we always have the CRA to help us and to guide us. So if we had questions, we could always call the CRA to get clarifications. You could also, refer to a tax accountant to help you as well. And then we usually use the slip system as well. So we use tax slips most of the time. So your employers, financial institutions would provide you with tax slips, which you would use to file your tax return. But as they give a copy to you, they also give a copy to the CRA. So the CRA kind of knows what to expect when you file your tax return. So the only areas where, you are required to put in the information yourself that the CRA might not be able to see.
Hello, sorry, Felicia. Sorry to
Yeah.
cut in there. I think some people are mentioning that you should increase your voice a little bit. Yeah, but I can hear you, but yeah.
Try removing the speaker, the headphones. Is it better?
I think it's quite better.
Okay. All right then.
Thank you.
So with business income and rental income or some other kinds of incomes where there are no tax slips involved, you're required to, provide all the full information, and you're supposed to properly report and file your tax return. So there are usually harsher penalties if you don't, because the CRA usually would not be able to decipher, they won't have information beforehand on what those numbers would look like. So in the instance where they find out that, there's been misinformation or not enough information, not enough income was declared, they usually, penalize harshly for those. And also, we also use deductions and tax credits when we're filing our tax returns. I'll talk a bit more about that in subsequent slides. So who must file a tax return? I'm going to take that with why we should file a tax return. So if you're expecting a refund, you've paid taxes, your employer has deducted taxes from your pay before giving it to you, it's advisable to file a tax return. So if in case you have a refund to collect, you'll be able to get that. And also, most of our tax credits are Canada CCB, childcare benefits, GST, HST, and all that benefits that we get are usually triggered by filing a tax return. So if you don't file a tax return, you might not be able to get, your benefits. If you have a loss to claim, it's advisable you file a tax return as well, because even though you might not be able to use that loss in current year, you might be able to carry it forward into future years. So it's advisable that you file a tax return. You might be entitled to refundable tax credit. I'll talk a bit about that later. So if you could be entitled to refundable tax credit, but if you don't file a return, you won't be able to get it. And then it's also, when you file a tax return, it helps you to start building your RSP contribution room early, even if you don't have taxes to pay. So it's advisable you file a tax return. As a student as well, even though you have no income, you have tuition credits that you can carry forward or you can transfer to a family member. Okay, so the tax filing deadlines for individuals, it's April 30th. For self-employed individuals, it's June 15. For spouses of self-employed individuals, it's June 15 as well. But you're supposed to pay whatever payments you owe to the CRA by the 30th of April. So technically, it then means that the CRA is kind of expecting you to file your tax return by April 30th, because how else are you going to know how much you owe on your tax return? Now, deceased taxpayers have till April 30th of the year after death or 6 months after the date of death to be able to file their tax returns. And for trust, estate trust, you have 90 days after the year end of the trust. So there are late filing penalties and interest for not, if you don't file your taxes on time, if there are penalties, you have, there are penalties and interest that you might have to pay. So you need to always take note of that. It's better to file your tax return, even if you're owing and you're not able to pay on time, it's better to still file that tax return before 30th of April. Okay, and then I just wanted to mention that, you know, we have something we call installment payments as well. And that usually happens when, if you file a tax return and you owed over $3,000, the CRA would the following year kind of send you a schedule to make installment payments. And what they're trying to say is that you kind of pay a bit for the following year's taxes. You kind of pay a bit of it now, so that when you file your tax return the following year, you know, you kind of you've saved up with them on the taxes, so the amount you would be owing would be smaller. You won't have to, you know, try to bring out so much cash to pay the tax return. And those installments are usually quarterly. So you might have a March 15, June 15, September 15, December 15. And usually if people who don't make those installment payments, if they do end up owing over $3,000 when they file their tax return, there'll be interest and penalties for not, you know, making those installment payments. But if you are sure that your tax situation has changed, you're not going to owe up to $3,000, and you don't need to make the installment payments because you know that you're not going to owe that much. Okay. What are the ways we have to file our tax returns? We can do that by paper. That's the slowest, most complicated method. I won't advise anyone to use that. And then some people have the option to file their return by phone, but this is mainly by invitation by the CRA. You can't decide you want to file your tax return on the telephone. You must receive an invitation to do this, and to tell you, the invitation letter will tell you how to go about it. It's usually for very simple tax returns, you know, tax returns that don't change year on year. So the CRA would have realized that this person's tax return doesn't change year on year. So, you know, they might invite them to file by phone, and it's usually for low or fixed incomes. And then you could also do e-filing with a tax preparer like me, so where you would provide us with your information and we'll file the tax return on your behalf. That's also done online. It's faster, it gives you faster refunds, improves accuracy, it's paperless and ease of mind. You kind of get your immediate confirmation that your tax return has been filed. Another option you have is to use online softwares. So you would have this is also called Netfile, where you could log on to maybe Eternal Block or TurboTax or Wealthsimple to get your taxes done by yourself. Some of them are free. Some of them you might need to pay some amount of money depending on your tax situation. And then we have the Community Volunteer Income Tax Program, which is more like free tax clinics where you can file your tax return. If you've been to the library or the community centers, you know, in this recent days, you probably you will see setups like that where, you know, you have people seated, you know, willing to assist people in filing their tax return for free. And it's usually for people with modest income and with simple tax situations. So you walk in, or you make an appointment, you go in there, and then one of the volunteers would assist with filing your tax return for you for free. And then also just to note that, you know, you should keep your documentation for 6 to 7 years in case the CRA decides to review a portion of your tax return in the future. Okay, so in Canada, we use the marginal tax rate system. And this is what gives rise to the tax brackets that we have. And the 2023 rates are here, and it's just for discussion purposes only. So it says here, so the first 15%, so the first $53,000 of your taxable income for the federal will be done at 15%. The next about $53,000 will be done at 20.5%. So what this means is that if you earn 100,000, if your gross income is 100,000, the first 53K of the 100K would be at 15%. And then the rest, the remaining 47K will be at 20.5%. So it's not going to be that because you earn 100K, you have fallen into the second bracket, so all your income is at 20.5%. No, that's not the way it works. So the first 15 would be, the first 53K will be at 15%, and then the excess, and then it keeps going like that until you get to 33%. And then we also have, as we also have, as we have the federal rates, we also have the provincial rates as well. So depending on your province of residence, you would also have tax rates that would apply and tax brackets that would apply to you as well. Okay, so the notice of assessment is what you get as confirmation that you filed the tax return. It will give you details of, you know, what you filed on your tax return. It will tell you whether you have a refund or if you're owing. It will tell you what your RSP contribution room for the subsequent year would be. It will tell you, you know, what credits you're carrying forward and what, you know, balances you might be able to use in subsequent years. So it's advisable that you keep your notices of assessment. It's also a third-party verification of your tax return, because if you go to the bank and you want to get a mortgage or a loan, usually they would ask for your notice of assessment. That's the way they can confirm the income that you earned in the subsequent years. So you will be able to see your notice of assessment on your CRA account online. If you log in, you'll be able to see prior years as well. But if you, for whatever reason, do not have access to your CRA online account and you need your notice of assessment, you can give the CRA a call and they will mail a copy to you at no charge. And then we have something we call the notice of reassessment. And this happens where there's been a change to your income, your deductions, or your tax credits, or your carried forward amounts to in a tax year. And the reason why you might have a change is it could be triggered by you, where you realize that and you made a mistake in your tax return, or you forgot to include some deductions, or you forgot to include some tax credits, or you forgot to include some income, and then you decided to amend your tax return. Or it could also be the CRE who realizes that you did not put in all the tax slips or, you know, information that you should have put in, or they asked you to substantiate an expense or a deduction that you had claimed on your tax return. You were unable to provide an answer, or you didn't provide an answer, they could assess your tax return. You could reassess your tax return, and with that, they will send you a notice of reassessment. And just note that you have, you're able to file an objection within 90 days of getting that notice of reassessment. So if you don't agree with what the CRA, the way the CRA has treated your reassessment or whatever the issue was, you can take it up with them. Okay, so I'd mentioned that we use the SLIP system of reporting. So we have T4s, T5s. T4s you get from employers, T5s you get from financial institutions. You got the T2202 from your universities. You get the T2200 conditions for employment expenses from your employer. You get the T4As, you know, from CPP or retirements, or, you know, you get the T4 RSP. So there are various kinds of tax slips, but in Canada, we majorly use the SLIP system of reporting to go. Okay, and then we have the personal tax credits, and we have some general rules. And then we have the refundable tax credit and the non-refundable tax credit. Now, the refundable tax credit are tax credits that even if you do not, even if you were not owing, you would still get a refund. Even if you were not expecting to get a refund, or you were not owing, if without that tax credit, you would have had a zero amount owing, you would still get a refund because it's a refundable tax credit. A non-refundable tax credit can only bring the amount you owe to zero. You don't get anything extra after that. So if you should have owed $200 and you had non-refundable tax credits of $500, it will bring your amount owing to zero, but you will not be able to get the $300 extra on it. That's what a non-refundable is. But a refundable, you'll be able to get the extra $300 on it if it's a refundable tax credit. Let's see. And then we've talked about the tax credits. Now we also have the tax deductions. Now the tax deductions reduce your taxable income. So the tax credit kind of helps you to reduce your tax liability, right? But the tax deduction reduces your taxable income, which is the basis for the taxes that you owe. So the tax deductions are more lucrative because they are being done at the marginal tax rate, which means that if my income was 100,000 before, and I had tax deductions of maybe, let's say, 20,000, then my taxable income comes down to 80,000. So you'll be applying the tax rate on 80,000 is what we would do. But for tax credits, if you had your income of 100,000 and we've computed that the taxes are whatever it is, let's just say you end up with $8,000 of taxes or $20,000 of taxes, your tax credits can only reduce that 8,000. that you were owing, unlike the tax deduction, which actually reduces your income. Reduces your income so that your tax, the amount you could possibly pay as taxes is reduced. Examples of tax deductions would be, examples of things you can use for tax deductions would be your IRSP. You can use your IRSP contributions to reduce as a tax deduction, childcare expenses, moving expenses, professional and union dues, employment expenses. Those are the kind of things you would be able to deduct on your tax return. Examples of tax credits would be the basic personal amount, age amount, donation credits, tuition credits, medical expenses, home buyers amounts, and all that. Okay, so examples of tax credits, basic personal amount, and this is available to all Canadian residents. And this is sometimes referred to as the tax-free amount. So for 2023, it's $15,000. What that means is that if you earn less than $15,000 in income, you will not pay taxes. That's the long and short of the basic personal amount. Canada employment amount can be claimed by any resident who has employment income, and it's a way to level the playing field with those who can write off expenses. So if you had a job, you'll be able to claim the Canada employment amount as a tax credit. And then you have tax credits for contributing to CPP and EI, but like most of you in paid employment would know that, when you get your pay stubs, you would usually see that your employer has deducted CPP, has deducted EI, you'll be able to get tax credits. It's kind of automatic. You would get tax credits on CPP and EI amounts that you have contributed in the year. Now, union and professional dues are a type of tax deduction. And for union dues, you only pay union dues if you're part of a union. So if your profession or your organization is unionized, usually they would deduct it from your pay. You usually don't have to pay it by yourself. They would have deducted it from your pay. So usually we see it on your tax slip. It would already be on your T4 slip. In that case, you would include it on your tax return when you're filing to get tax deductions. Now, for professional fees and insurance, it's fees you pay to an association for membership or liability insurance premiums paid to maintain status in an organization, and they should be related to employment. So if you are let's say you were a teacher, teaching in an elementary school, in a high school, for instance, and you also pay CPA dues, it is you will not be expected to deduct the CPA dues as an accountant on your tax return because it's not related to your employment. I hope you understand what I mean by that. So your fees and professional dues should be related to your employment all the time. Okay, so we have donation tax credits, and this is when we make donations to charities. So first of all, the rule is that you must be making a donation to a charity for it to qualify, and to know if it's a charity, if wherever you're donating to has a charity status, there must be a charity registration number on the receipts that you would get. So that's the only reason, the only time you'll be able to claim donation receipts. And then each spouse can claim the credit, or it can be split. But I would advise that you claim, if you're a couple, that you claim it on one person's tax return, because the way the donation tax credits are computed are different from all other tax credits. And it only makes you leave money on the table if you take your own donation receipts and put it on your tax return, and your spouse takes their own donation receipts and put it on their tax return. You leave money on the table, but if you put it all together, you get a better deal. You get a better tax outcome for the family. Okay, also to note that you cannot contribute more than 75% of your income as donation, because I guess the question becomes, if you contributed over 75% of your income as donation, how are you surviving, right? So the threshold is 75%, and you can always claim your donations for 5 years, which means that if you donated this year and you didn't need it on your tax return, you can always carry it subsequently for the next 5 years. So it's advisable that you keep your slips, you get your donation letters and have them in hand. I know it's an area that the CRA usually tries to verify as well. And if they realize that you have claimed on your return donations that you have no receipts for and all that, they would disallow those credits and reassess you for it. And then we have medical expenses, and then so your medical expense for yourself, for your spouse, for your children. This is when you pay for out of pocket. maybe you have to pay for medication, you have to pay for some tests out of pocket, you'll be able to claim that on your tax return. And then also if you paid for personal or private insurance, health insurance, you'll be able to claim the premiums on your tax return as well. Okay. Let's see. So moving expenses, it's a type of tax deduction. You can claim moving expenses if you move to work or to run a business or to study full-time at an educational institution, and you moved at least 40 kilometers closer to your new work location or your school. So if you change cities and you got a job after you change cities, you will not be able to claim moving expenses. However, if you got a job if you're living in Toronto and you got a job maybe in Ottawa, for instance, and you had to move to Ottawa, to be able to walk closer to the office, then you'll be able to claim moving expenses. And expenses are limited to the amount of eligible income earned at the new location. So if from the time you got the new job to the end of the year, you probably earned just 30K, you cannot claim more than 30K in moving expenses on your tax return. However, you can carry the remaining expenses forward into the next year. Okay. And what kind of expenses can you, let's see, do I have that here? What kind of expenses can you deduct? You can deduct transportation and storage costs, traveling expenses, cost of up to 15 days for meals and temporary accommodation, cost of canceling a lease for an old residence. You would be able to claim. What you would not be able to claim is expenses for work done to make a former residence more sellable, any loss from the sale of your home, expenses for house hunting trips. So you were going around to see houses that you would like to rent, you won't be able to claim that on your return. Expenses for job hunting in another city, you will not be able to claim. Expenses to clean or repair former rented residence to meet the landlord's standards, you will not be able to claim. So there are just a couple of things you will not be able to claim on your return. Okay, so I'm focusing now on students and the kind of things they should have in mind when they're filing a tax return. The first one is the tuition, education, and textbook amounts. Is the biggest, part of the tax return for a student, because some students do not work. So, but they have the tuition amount. So that's why I said it's advisable you still file your tax return, because your school will give you a tuition slip, and that slip needs to be filed on your tax return. The credit you would get on it will be used to reduce the amount that you would owe. Now, if you don't have any income in this year, you still need to file so that it can carry forward to subsequent years. So you can carry it forward forever, up to the point where you begin to earn income, and you would be able to use some of those tuition credits to reduce your tax liability. And you could also transfer, just to mention that you could also transfer to your spouse, you can transfer to your parent if your parent is resident here and filing a tax return. And I mentioned this tuition because, a lot of us pay quite a large amount for tuition. So it's better to file your tax return so you can, enjoy the benefits of that in the future. So what also matters to students, interest on student loans. So it's only the interest on the Canada Student Loans and the Canada Student Financial Assistance Act that you can claim, and other provincial ones that you can claim on your tax return. So if you had personal loans or lines of credit that you used, you probably went to the bank and borrowed some money to go to school, you won't be able to claim that on your tax return because it's not under the Act, the Canada Student Loans Act. So it is only things, that relate to the Canada Student Loans Act that you would be able to claim on your tax return. So it's the interest on the student loan. So when you eventually begin to pay interest on the loans, then you'll be able to claim those on your tax return. Okay, so I've mentioned the tuition amounts, transfer. You can transfer to your spouse, to your parent, to your grandparent. You can only transfer up to a maximum of $5,000, and you can only transfer from current year's tuition. So if you didn't transfer to your spouse last year, you cannot decide that this year I'm going to take 5,000 from last year and put that on my spouse's tax return. No, unless you want to go back to the prior year to refile your tax return. Okay, and then there's usually on the tuition slip a part where you can sign off on to say I'm transferring XXX amount to so and so, and you sign off on that. That's what the other person would use to get that transfer of the tuition credit. Okay, and then so we have people that get scholarships, bursaries, and grants. You usually would get a T4A slip when you do that. Just to mention that usually scholarships, when you're schooling full time, usually the even though you report the income you received as a scholarship or as a grant on your tax return, it's usually not taxable. Okay, so I've mentioned the benefits of filing as a tax, filing your return as a student. I'm not going to go over that again. So if for couples, the things you should note, first one is the spouse or common law partner amount. It can be claimed when one spouse has income below the specified threshold. So for 2023, the specified threshold is $15,000, which is like a basic personal amount. So what we are saying here is that if your spouse earns less than $15,000, you can use the balance. If your spouse did not earn any income, for instance, you can claim your spouse's $15,000 credit on $15,000 on your own tax return to get a tax credit on it. So if your spouse earned $7,000, you'd only be able to claim $8,000 on your tax return. So it depends on what your spouse earned. But if your spouse earned over $15,000, then you get nothing. So that's the way that one works. Okay, and then spousal and child support for those that may be separated. Maybe if you're paying, okay, we are all ladies here, so maybe this might not really apply. But if you get I would have said if someone is providing child support payment, the person would not be able to claim that on their tax return. So a father is paying child support payments to the ex-wife to take care of the kids. That person will not be able to claim it on their tax return. However, the alimony payment, if the court had ordered that a certain amount needs to be paid to the ex, for whatever reason, it's taxable to the person receiving it, and it's deductible for the person paying it. So you'll be able to include that on your tax return. And then for parents, the major one is childcare expenses. Now for childcare expenses, it's deductible, it's allowed so that you can go to school or work. So, both the couple must either be in school or working. If anyone is working from home, if anyone has no job and is not working, you will not be able to claim the childcare expenses, because it's expected that you should be able to take care of your child at home by yourself since you're not in school and you're not working. All right, and you cannot exceed 2/3 of your earned income. So 66% you can't spend more than 66% of your income on childcare expenses. And then the receipts must include the parent's name, the amount paid, the payment date, and the signature of the childcare provider. And usually the childcare expense is deducted by the spouse with the lower income. And then amount for eligible dependent. This happens when you don't have a spouse or a partner, and you're supporting a child. You would be able to claim an amount for eligible dependent, and that amount is for 2023 is $15,000 as well. Okay, and then we have the adoption tax credit. If you adopted a child during the year, you'll be able to claim the adoption tax credit on your tax return. And for those that might be elderly, the things you should take note of: age credit. It's for individuals who are 65 years and older in the tax year. And if you're not using everything, you can always transfer to your spouse, as long as your spouse is also over the age of 65 years. And then we have the pension amount credit. This is for those who are collecting pension as their income. They'll be able to claim a credit of $2,000 on their tax return. And then we have, for those that might have, family members with disabilities or might have disabilities by themselves, the major one is a disability amount. And it's the person must have a severe and prolonged impairment in physical or mental functions, and it must be expected to last at least 12 months. And the way to claim it is to get a disability tax credit certificate from the CRA. So you'd fill out the form, a medical practitioner will corroborate by signing off and explaining to the CRA what kind of disability and how it affects the functions and all that. Once the CRA approves it, you'd be able to get a tax credit on your tax return. And the same thing for the Canada Caregiver Tax Credit. It's related to the disability as well in being able to claim that. Okay, so we'll go on to those who are self-employed. What do you need to take note of? We need to take note of the difference between personal business versus corporation. So If you're into a business, you didn't incorporate a company, it's expected that your income and your expenses on that business shows up on your personal income tax return. If you incorporated a company, then it's expected that you would not put those details on your personal tax return. You would file a corporate tax return for that. Okay, and you would need the T2125 statement of business activities on your personal income tax return to file your tax return for your business. And you have your income statement, you provide details of your income, details of all your expenses, and then usually the profit. So income less the expenses is what will be taxed, will become your taxable income. Okay, and what kind of expenses can you claim? Vehicle expenses, depending on the nature of your business. So note that it's only the business use portion that you can claim. You cannot claim the personal portion of your vehicle. So if you're using your vehicle for personal and business, you need to be able to track what portion of it you're using for business, what portion of it you're using for personal, and then only claim the business portion of it on your tax return. And usually the CRA advises that we use a kilometer log, where you kind of log the date where you went to, what the mileage was when you started, when the mileage was when it ended, and all that. This is the way the CRA likes to do it. I know that a lot of people don't do it. A lot of people just estimate that. I would say I use my car for 25% of the time. I use my car for 65% of the time for business and all that. But ideally, this is the right way to do it. You're supposed to keep a log of your kilometers. Okay, so you could claim advertising and promotion expenses, meals and entertainment, insurance. Now, when I say insurance, I'm not talking about car insurance, because that would already fall under vehicle expenses. I'm not talking about mortgage insurance as well, because that will fall under home office expenses. Okay, so interest, if you have a line of credit, you have a business that you borrow money from the bank and you're paying interest, you'd be able to claim that on your tax return as well. Office expenses, if you rented a place to run your business, you'd be able to claim that on your tax return. Office supplies, you'd be able to claim on your tax return. Home office expenses, if you're working from home, if you're running your business from the home, you'd be able to claim a portion of your home expenses as a business expense. So for instance, you'd be able to claim your interest on the mortgage that you're paying, property taxes, you'll be able to take utilities, repairs and maintenance, and all that you'll be able to claim on your tax return, but it has to be based on the portion of your house that you're using for the business. So if you're using a space, maybe you decide to use your basement for your office, and your basement is 20% of your house, and when you measure the square feet, and you say 20% of your house, and you'll be able to claim 20% of your mortgage interest, 20% of your property taxes, or your rent, or your utilities, you'll be able to claim that on your tax return. So for home office rules, and I think the first thing is that you can only claim if it is the primary place that you do business. If you rent an office space somewhere else, you cannot claim it. So you cannot say that I'm using my basement for my business, but I also have an office that I go to every day. You won't be able to claim the home one in your house. And then the home office expense can only reduce your business profit to zero. It cannot take it to negative. So, but however, you can carry forward the balance of the expenses you were able to use on your tax return onto the subsequent year. Okay, so homeowners, take note. We're moving to you guys. Usually because we've seen that as we settle down, we don't begin to have one property, two properties. We begin to rent out, a portion of our homes and all that. So I just wanted to mention, the things you should take note of: rental income. It's important that if you're renting out a portion of your home, or you're renting out a home as a whole, you need to report that income. And then you also need to report that you'd also be able to put the expense in as well. And I think I'll go to that on another slide. And I just wanted to also mention, you need to know when you're carrying out a business, when is it a business and when is it a rental. So if you can show you're running a business, you cannot deduct, you can deduct additional expenses. But if it's a rental income, then it's only the income related to the rentals you'll be able to deduct. I'll take a bit more about that. So what's the difference in rental and business income? If you're just providing the space where the individual would live, you're not doing anything else. Like you rent out your basement, you just give them and they take care of themselves, or you rent out a house, they take care of themselves. that will be considered rental income. So to be considered a business, you have to be offering additional services like maybe bed and breakfast, providing food, cleaning services, transportation, and all those kind of things. You know, you're doing more than just giving the house and walking away. Then it would become a business, and then you'd be able to claim more expenses on it. So even though you have more than one rental property, doesn't make it a business. So it doesn't mean that because you have more than one property, then you're running a business. No, it doesn't matter. As long as you're not providing those additional services, it's still a rental business that you're doing. Okay, so to report rental income, you fill out the T776 on your tax return. And then if you jointly own the property with someone, you would be able to, both of you would be able to report that on your tax return. So, based on whatever percentage you guys own, but you need to stay consistent. So if it's 50-50 that you were doing, you need to stick with 50-50. You cannot wake up next year and decide that it's 60-40 because our tax situation has changed. Maybe this person earning a bit lower, so let's give her 70% so that our tax balances out. You need to be as consistent as possible. Okay. Spoken about this. So what kind of rental expenses? So you can deduct your interest, mortgage interest, property taxes, insurance, home insurance, condo fees, maintenance and repairs. Depending on the kind of arrangement you have, you might be able to deduct utilities, a portion of utilities. So if for instance, you're the one paying the utilities for the tenant, or maybe the tenant lives in your basement and you're still splitting the heating costs and all that, then you'll be able to claim a portion, the rental portion of it on your tax return. Non-deductible expenses, you cannot deduct the mortgage principal, you cannot deduct land transfer taxes, you cannot deduct penalties. So if you didn't pay your property taxes on time and there were penalties, you can claim that on your tax return. If you decide the sink was leaking and you fixed it yourself and you know that, okay, I would have paid about $300 to fix that sink if I'd called somebody in. Therefore, I'm going to put that $300 as repairs and maintenance. You can't do that. So as long as you didn't give her that money, you cannot claim it on your tax return. Okay. So interest expense deduction, or so if you're able to, so even if you have a line of credit, it's advisable that it's tied to your rental, right? But as long as you're able to claim to demarcate between what portion of your line of credit interest relates to personal and what relates to the rental, you can claim the rental bit on your tax return. Okay, we've talked about the rental expenses, and so I just want to mention, sometimes people are not clear on what constitutes repair and maintenance and what might be a capital improvement, which you cannot put as a rental expense. So capital expenses are renovations and expenses that extend the property's useful life and are added to the capital pool. So if I decided I was going to change all my windows, maybe to give it a new look, I won't be able to claim that as an expense. However, when I'm valuing my house, when I decide to sell my house, I would include it as part of the cost of my house to determine what my capital gains will be. So that's what capital improvement does. Repairs and maintenance are expense if only it brings the property back to its original position. So if, for instance, I replaced carpets, or I've painted the house, or I fixed the leaking roof, I fixed or replaced damaged floors, those kind of things would fall under repairs and maintenance, and you'll be able to claim them as a rental expense. Okay. Let's see. Okay, so we have 2023 tax updates. What's changing in this year's tax filing that we're doing? So the deadline for filing is Tuesday, April 30th, 2024. And then the deadline for contributing to RSP is today, February 29th. So if you haven't done that yet, whatever you contribute starting from tomorrow would go into as your part of your 2024 RSP contribution. The limit for TFSA for 2024 increased to 7,000 from 6,500 last year. And we now have, sometime in April 2023, the government came up with the First Home Savings Account, FHSA, and it allows a maximum contribution of $8,000 per year, up to a maximum of $40,000. So if you're a new homeowner, you're trying to save, to buy a house for the first time, you can, contribute to your First Home Savings Account, and that amount becomes a tax deduction. So you would be able to file that on your tax return and get benefits for it. And then the government also came up with a new Canadian Dental Care Plan. This is based on income requirements. Families making less than $90,000 per year might be able to get it. The application is opening in phases. And there's been a shift in the tax bracket to account for inflation. So, the table I showed you on the marginal tax rates, I think prior to that, it was the first 49,000 was at 15%. So they kind of shifted it to make things better just to account for inflation for us all. Okay, and then the disability tax credit went digital in 2023. And what that means is that instead of filling out those forms, the way we will fill it on paper and send it to the CRA and then take it to our doctor, they will fill out and they will mail it to the CRA. And usually it used to take months. The CRA has come up with a way where you can actually do it on your CRA account online. And then you fill it out, you get a reference number, you provide that to your medical practitioner, and he logs in somewhere else and is able to fill out his own. So it makes the process a whole lot faster than what it used to be. Now, the COVID-19 benefits have all expired, so there's no more work from home expenses, the $2 per day up to a maximum of 250 days we used to have on our tax return. That doesn't exist anymore. In Ontario, we used to have the Ontario Staycation tax credit, where if you go on vacation somewhere in Ontario and you pay for accommodation in a hotel, you'll be able to get some tax credit on that. All that has come to an end. Okay, and then we also have the new multi-generational home renovation tax credit. If eligible, you can claim up to 50K in qualifying expenditures. And then we also have the property flipping rule. So starting January 1st, 2023, any gain from sale of a house located in Canada that was owned for less than 1 year before sale is deemed to be business income and not capital gain. And what that means is usually when you have a capital gain, it's 50% of the gain that's actually taxable income. Whereas if it's business income, it's 100%, right? So they're trying to tell you now that if you hold a property for less than a year, it then means that it is not, you didn't plan to live in it, you didn't plan to keep it, so it was a business you were trying to do in the first place. So you wouldn't be able to claim capital gains on it. They would take it as income that you earned, and you would have to pay taxes on the full 100%. So we need to be careful when we are buying properties and when we are selling properties to ensure that if it's the business we're doing, we know the tax implication of what we're doing. So I think that brings us to the end of that presentation. Final words: be informed, research, call the CRA to clarify or engage a tax consultant. If you make a mistake on your tax return, you can adjust your tax return. It's not a big deal. File your returns before the deadline to avoid interest and penalties. Register for your CRA account online. It's very important. You can get all your information from there. You can get you can see copies of your T4 slips in there. Copies of your notice of assessments are in there. You can change your address, change your banking information. You can see everything that is going on. So instead of waiting on the line, calling the CRA and waiting on the line for hours to get information, you can actually get that information from your CRA account online. So it's advisable that you actually get that registered and get that done, and keep your receipts and your documents, as I mentioned, 6 to 7 years in case the CRA needs to see them. And then stay true as much as possible. Try to ensure that you're filing accurate tax returns. Okay, so that brings me to the end of my presentation, and I know there will be a lot of questions, so we'll go for the questions.
Thank you so much for the show. Thank you. This has
amazing.
been
Amazing. This is awesome. Thank you so much. A lot of information. Yeah. Awesome.
Thank you. There's so much I learned. One of them is I didn't know students had to file tax. I'm sure a lot of people didn't know. So I know that now. And then I know you mentioned donation tax credits. It's better for one spouse to claim it. So I didn't know that. That's a new one. There's so many things, and I think the final thing you mentioned, that's an action item for me. I need to go look for my documents from my previous tax filing and keep them just in case. I'm not sure where they are, but I have to go look for them. So thank you so much. This has been interesting. So we have a lot of questions and we'll get into it. So I'll start with the first one. The question is, what's the maximum annual income of a single person that will not attract payback to the government?
So like I'd mentioned, the maximum would be the basic personal amount. So for this year, it's $15,000. So if you earn less than $15,000 or you earn $15,000, you won't pay taxes because the basic personal amount would kind of nail it off. So it would technically come to zero. So it's $15,000.
Thank you. As we're asking the questions, you have more, you can drop it in the chat and we can take up the questions. So the second question I have is, for a joint savings account that the bank sent a T5 for the interest earned on the joint account, it was sent as a hard copy and no soft copy is in either party's CRA account. Will both parties have to file that income or interest separately, or will one person file while the other doesn't?
So it depends whose social insurance number was on it. So you have two options. Option one is you use whoever social insurance number is on it to file the tax return. That's probably the easiest way because, eventually the T5 will find its way to the CRA and they will tie it based on the social insurance number. However, if you decided you wanted to split it into two because it's a joint account, you can as well. So even if the CRA comes out to ask, what was the basis for, doing it, then, you'll be able to show them that, look, it's a split, we both have money in it, it's a joint account, and we split it 50-50. There'll be no problem with that.
Thank you so much. Thank you. We have another question. For someone that works remotely or hybrid, do you get additional slip to be able to write off a portion of your rent or mortgage from your employer?
Yeah, so you would need a T2200, Conditions for Employment Expenses. It's a form that your employer would fill out. It's like a questionnaire, and then it kind of tells you what kind of expenses you can claim, what kind of employment expenses you are allowed, that they are allowing you. For some people, it might be very coded because maybe if you're a social worker, you need to visit different places. So they'll tell on that kind of slip, they would tick that, okay, you need to be able to claim your vehicle, because you're using your personal vehicle and your personal gas and all that. So you need to be able to claim that on your tax return. For those who work from home, if the employer, allows you to work from home and they want to give you a slip as well, there's a portion for it as well, but they would tick where it says that you should be able to claim home office expenses. So if you don't have that slip, you won't be able to claim it. Previously, because of COVID and all that, we are all able to, even if we didn't get that slip from our employer, we could do the simple method where it's $2 per day up to a maximum of 250 days, and we claim that on our tax return. But that has ended with COVID. They didn't offer that in the 2023 tax season. So unless you have that T2200 from your employer, you won't be able to claim home office expenses.
Thank you. Thank you. So I see some questions coming in the chat. We'll take them. Let's just complete the ones we got previously when Fudusho was speaking. So this question is, can you explain the process of claiming the credit if a spouse earned less than 15,000 in the year?
Okay. So the easiest way to do it is if you're filing online. So either you're using a tax consultant, or if you're doing it yourself using one of those net files like Wealthsimple or those other kinds of, because with those, if you're filing as a couple, when I say filing as a couple now, I'm saying that you're putting your returns together, you're preparing them simultaneously, but you're still going to send out two tax returns at the end of the day. So, the system, whatever software or system we're using would be able to tell us what is left. So let me just explain it this way. If your spouse earned nothing in that year, automatically we will take the 15,000 and add it as a tax credit to your own tax return. However, because it's a maximum of 15,000, right? If your spouse earned 10,000, right? Because your spouse needs to use that 10,000 not to pay tax. So all that is available for you to use will be 5,000. So we'll transfer the balance of the 5,000 to you. But if your spouse earns over 15,000, there's nothing left for you to take from your spouse. I hope it's clear that way.
Yes, thank you. I have another question here. Just if you lease the car in your name and also have a registered incorporation, can you claim the lease?
And so it depends. If you're using the car for business purposes, you'll be able to claim the portion that you're using for business on your on your corporate tax return or on your business return, so to say.
Okay, thank you. I'll take one of the questions from the chat. It says, can you clarify items under the donation umbrella?
Under what?
The donation umbrella. I know you mentioned donation tax credits.
Yeah.
So what can we claim under that donation?
So if you donated to a church or a religious institution or a mosque, as long as they have a charity number. So it's not every institution that has a charity number. So sometimes we realize that we've donated to GoFundMe, for instance. GoFundMe is not a charity, so to say. It's just a place where people come together to put money together, right? So as long as GoFundMe doesn't have a charity number, it's not registered in Canada as a charity, you wouldn't be able to claim whatever donations you made or whatever contributions you made in there on your tax return. So whatever it is you're doing, just ensure that that company or that institution is a registered charity and has a charity number. Most religious organizations usually would have registered charity numbers.
So I know we have a lot of questions in the chat. A lot of people are eager to ask you questions, like burning questions. And of course, we are going to give chance for those that want to speak to like ask their questions. It's not a must we are going to answer all the questions, but of course you can see Felicia's contact on the screen, because if we didn't get to answer your question, you can reach out to her, and of course she's ready to take whatever question you have, or you can share it in our community and we'll pass it across to her. But we want to give grace to some people that want to raise their hand and ask questions. So if you feel like there are burning questions you need her to like clarify to you one-on-one, please raise your hand and we'll give you the chance to unmute yourself and ask the question. Ijoma, I hope that's fine.
Yeah, yes, yeah. I have one, just one, and then we can go that way. So I think the last here is there a deadline for TFSA, and can we add last year's limit to this year's 7K?
Yeah, so for TFSA, there is no deadline for TFSA. And if you didn't use your room last year, you can add it to this year. So if, for instance, you've been in Canada maybe for the past 5 years and you never contributed to your TFSA, all you need to do is add the rooms for the last years, add them all together, and that will be your TFSA room that you would have. So you can keep carrying it forward till whenever you decide to use it. There is no deadline.
Okay, thank you. So now we'll take Chioma Yu. You can unmute yourself and ask your question.
Hello, everyone. Good evening. Can you hear me?
Yes, you can.
Okay, thank you so much. It's been a very informative session. Thank you very much. My first question is, can I write off expenses related to home improvement from my personal tax filing? So something like furnace replacement, water heater repair. Can I write that off?
No, you won't be able to write those off. Unless a portion of your home was used for business, and then you can claim, because it's more like repairs and maintenance, so you might be able to claim a portion of it on your tax return.
I actually work from home full time. So I don't know if maybe if I have the T2200.
T2200, then you can deduct a portion of those repairs and maintenance on your tax return as well, under home expenses.
Okay, so kind of still follow up, right? I also have an incorporation using the same address. So I'm also thinking, is it better to now move everything to the incorporation, like business tax filing, though I've made no money on the business?
So it depends. And, this area is something the CRA, kind of digs into sometimes. And it is that, like I'm sitting right here, Perhaps I'm working from home on the same desk, and then I'm doing my personal business on the same desk. So what portion of your home? So you just need to be clear on how you're arriving at the percentage you're using to share your expenses. So you just need to know what you're doing and know that you're not duplicating. It's not the same. You're not using the same space. Because you've claimed it. So, sometimes the CRA goes as far as details. How many hours in a day are you using that space for? So you get what I mean? So you just need to, come up with something very reasonable to determine how you are portioning. So you can actually do home office on your personal and home office on your business if you're able to split into two, how much time and, what percentage and all that you're using that space for.
Okay. My final question would be on, so I've bought furniture like, computers and all that for the business, but I haven't made money. Can I still write that off?
Yeah, but usually computers, for instance, and furniture are assets. So you might be able to amortize, you might be able to claim capital cost allocations on them. You might not be able to write the whole thing as an expense in the first year. Or you might be able to do it over a couple of years. So even though you haven't earned any income, it's still fine to include that on your corporate tax return.
Okay, thank you so much.
You're welcome.
Thank you. So we will take James. James, you can unmute yourself and ask your question.
Right. Good day. Thank you, Wintech, and everybody for organizing this. Okay. My question is, I have a young friend who entered Canada as a PR holder. I think that was like in April last year, and he's still searching for a job. But he just took up, barbing kits, going around homes to, people called him, and surprisingly, he told me he made some money. I'm sure it's, more than 15,000, but majority of which are cash. After barbing, they just give him cash. So he's asking, how does he file tax? He's totally confused. He doesn't even know what to present.
Okay, so ideally, you should add up all you received, even though it was in cash, and declare it as income. That's the proper way to do it. So whatever is earned in that 2023 with regards to that business, and then you might be able to claim expenses. So if you had to, move to a client, drive to a client site or take Uber to a client site, you'll be able to deduct those kind of expenses from his income to arrive at the taxable income that the taxes will be determined on. But it's supposed to declare all his income, whether it's cash, whether it's check, whether it's Interact, whatever it is, whether I issued a receipt or not.
Oh, okay. So the receipt you are talking about is expense like Uber and stuff you're talking about.
If he has those ones, he will be able to claim those expenses. But then even if he didn't issue receipts to his clients, as long as he got paid, he earned income. So he should declare it on his tax return.
Oh, okay. It's clear. Thank you so much.
You're welcome.
Thank you. So I'll take a question from direct message, and then we'll also get someone to ask question from the group. So Rekia is asking, can you claim taxes on school fees and allowance sent to Nigeria? And also, can you claim taxes on flight tickets for your children from Nigeria to Canada?
No, you can't. That's the long and short of it.
Okay. So Shanice,
because they're personal expenses, right? So yeah, so you can't claim personal expenses on your tax return.
Okay, thank you. So Shanice, you can unmute yourself and ask your question.
Hi, good night. Thank you very much. Great presentation. My question is in regards to the medical expenses. You said we could claim those on our T4. You said we could claim those on our T4.
Yeah, you could claim some. You could claim them on your tax return. Yeah.
Yeah. Tax returns. My question is, am I able to like claim like eyewear, like my glasses and stuff like that, or is there a certain amount, a limit that I could like claim on my tax?
Yeah, so you could claim your eyeglasses, your lenses, your visit to the optician, you know, dental, labs, prescription medication, you know, I mean, anything medical. There's a whole list of that on the CRA website, but usually you'll be able to claim anything medical that you paid out of pocket.
Yes,
on your
out of
tax return. Yeah.
pocket. Also with the CRA, because I've never claimed those before, so that's the reason I'm asking. Also, will the CRA ask for receipts? I do have the receipts. I'm just curious as if they'll
Yeah,
ask.
so because most of us file electronically now, when you're submitting the tax return, you won't put the receipts on. But even after you've gotten your refund, it might be months later, you might just get a nice letter from the CRA saying that, you know, they're just checking, could you provide the receipts? It might happen, it might never happen, but it's just
Yes.
good to have your receipts in case they do ask for it.
Definitely. And one last question, because I did not know that even though I'm finished with school, I recently finished paying off my student loans with ESDC, which is Employment and Social Development Canada. I got a letter saying that my account has been cleared, but you're saying in the presentation early on that we could actually claim the interest that was accumulated on that student loan. So would you suggest that I call ESDC and ask them for like a tax slip so I could
Yes.
like,
Yeah.
okay, is there a particular name for that slip, or do I just say that to them? And
you would probably just tell them that you wanted to get your receipt. I'll call it your receipt, your interest on your tax receipt for your
my
interest on
tax receipt.
student
Okay.
loans. Yeah,
Awesome.
for the interest on the loans you paid.
And one last thing, where on the my T4 would I claim that again?
On your tax return, it will be on the
Like on what line? Because there's so many lines.
yeah,
Like I
there's so
know that I
many
could claim
lines.
for.
One sec, let me just check. Let me go back and see if I can find it.
Or if it's taking too long, I could reach out to you.
Yeah, another thing
reach
you can
out,
do,
yeah.
Shannon, is to reach out to her.
Okay, thank you.
Yeah.
Take time.
Yeah,
Thank you
I'll
very
probably
much.
find that. All right.
Awesome.
Thank you. We are almost out of time. We'll just take a few more questions, and then if we're not able to answer your question, please bear with us. You can reach out to Funshot later, and you can also send us some questions, and we can also share with her. So we have a question in the chat. Please explain Canada employment amount. That's from Sandra. Hello?
Hi.
Can you hear me?
Yeah, I can hear you now.
Okay. There's a question from Sandra. Please explain Canada employment amount.
Okay, so the Canada employment amount is a kind of tax credit for everyone who works in Canada, who has a job basically, right? So it's an amount, it's like a tax credit. I think it's 1,300 and something. It's just a tax credit that the government gives for having a job.
Okay. Thank you. And then Angela, thank you. That'll be the last question we can take. You can unmute yourself.
Okay. Thank you very much. Good evening, everyone. My question is just a quick one. Please, could you just touch briefly on world income, especially for a spouse that doesn't work in Canada, but is a PR and is not here, but currently working in Nigeria? I'm just wondering what do you file for such a spouse?
So if the spouse is not here and is not a resident of Canada, the spouse
Is a permanent resident, but currently in Nigeria.
So I guess the question becomes, should he even be filing a tax return? So it's not, unless we have more information, to be able to determine, how long was he in Canada, is he planning to stay? So many other things will factor into determine whether he's a resident for tax purposes, because you can be a permanent resident but not be a resident for tax purposes.
Oh, okay. Maybe I'll reach out to you personally.
Okay.
Thank you.
All right. Sounds good.
Okay, I think we have just a minute more. There's a question here from Kayode. I think that'll be the last one. So for someone doing Uber, what can I write off? And when I was opening my HST account, I chose to pay monthly, but someone said I can wait till the end of the year to file my tax return and I can pay it by then.
Okay, so first of all, if you chose monthly, you have to file your HST monthly and pay monthly. You can't just decide not to do it that way anymore. So unless if you wanted to change it, then you'd give CRA a call to let them know that you wanted to switch from monthly to annually. That is possible, but then you can't decide not to do it the way that was agreed from in the first place. That's the first point. Now for the Uber, you would be able to claim vehicle expenses majorly. So what portion of your vehicle are you using for Uber? And then you'll be able to claim car insurance, repairs and maintenance, gas, tolls, whatever it is, you'll be able to claim a portion of your vehicle expenses on your tax return.
Okay, thank you for that. So I think we're out of time, and so you can reach out to Felicia. Her details are here, and for further questions and a consultation. We have a WinTech Instagram page. We have our LinkedIn handle. We have a YouTube channel, and we'll be sharing the address here so that you can follow us for more information. And then we also have programs at the end of every month. So we hope you look forward to other programs we have and events and connect with us. So please follow us, and you can also watch our YouTube videos from the previous events we had and get more information educated. So that will be all from me from here. I'll be handing over to Wendy, founder of WinTech. She will give us the closing remarks. Thank you.
Yeah, thank you so much, Ijoma. Thank you so much, everyone. And Felicia, I don't know how to express my joy. I want to say a big thank you. You nailed it. Honestly speaking, there are so many things that you said tonight that if I look back, I don't think I have those information prior to now. And I believe that there are even more that going back to listen to this recording, I will be able to grab more information based on what you taught us tonight. And we want to say a big thank you to you. You've done so well. We really appreciate you. And for the audience that joined us tonight, it has been amazing. Thank you so much. We have solid 120-something personalities in this room. We really appreciate you. And at this point, I want to hand it over to one of our team members who is going to be saying the last prayer for us before we call it a night. When I told her she's going to say the last prayer, she started laughing. So permit me to call Tolu. Tolu, please go ahead and say the last prayer, okay?
Thank you, Wendy. Thank you,
All
Wendy.
right.
And indeed, thank you, Felicia. We can't oversay thank you. It's been a powerful session, very knowledgeable, lots of information. And thank you so much for taking out the time to break down the filing in terms of taxes to us. And I also want to say a big thank you to all our participants, 120 of you. Thank you so much. I know there's a lot to do in the evening, but taking out the time just to listen into this session, we are very, very grateful. And we want to say a big thank you to Ijoma for moderating this session as well. Thank you for the Q&A and everything, and also to the WinTech community itself, the board, the ladies. We want to say thank you for also organizing this session. And for Wendy, thank you for the opportunity to even have this session and to have WinTech also as a community. We do want to encourage you to join our community. For our ladies out there, the men, sorry, but you can join NIPCA. But for the women, please join our community. As earlier introduced by Wendy, we're a community for women helping each other in tech and just, creating that family. And in the chat, we have shared the registration link. So please check through the chat, or Ijoma, please help me to repost it. So just click on the link, fill out the form, and you will be added to the community. Also connect with us on LinkedIn, YouTube, TikTok, Instagram. We are everywhere. So you will see us. And this recording will also be available on our YouTube channel. So it's there for you to replay and also learn more and more, because I know there's a lot of information. It's packed. So you do need to take your time to really understand what has been given to us this evening. So once again, on behalf of the WINTEC board, we say thank you to Felicia, thank you to our participants, and we hope to see you in future sessions as well. Thank you. I do have a wonderful evening. Take care.
Thank you,
Awesome.
everyone.
Thank you, everyone, and good night.
Good night.
Thank you, everyone. Good
Thank
night.
you. Good night.